You ever get the feeling that when it comes to money, the super rich are playing a totally different game than the rest of us? Well, today we're going to peel back the curtain and look at their actual playbook. And trust me, it's probably not what you're expecting.
Right. So we all know the ultra-wealthy are getting richer. That's not a surprise. But the real question is, how? Are they part of some secret club? Do they just have inside information? Or are they just taking these massive, wild risks that happen to pay off? Turns out, the real answer is a lot more interesting.
So for the first time ever, a new study has managed to crack open a proprietary database of actual investment portfolios. And this is huge. This isn't based on surveys or just asking people what they own. No, this is a real, hard data, unprecedented peek behind the curtain at how America's wealthiest investors actually manage their money. Okay, so let's get right into it and start with the most basic question of all. What are they actually buying with all that money? So have a look at this. This is a portfolio for an investor with under $3 million. It probably looks pretty familiar, right? More than half of it is in public stocks. But what I want you to pay attention to is that tiny little sliver down there for alternatives. It's just 9%. Now keep that in mind and watch what happens next.
Okay, now we're looking at portfolios for people with over $100 million. And whoa, it's a completely different picture. Public stocks, that's down to just a third. And remember that tiny alternative slice? Well, here, it has absolutely exploded to more than a quarter of their entire net worth. This right here is our first big clue.
So what even are these alternatives we're talking about? Well, to put it simply, they're just investments that fall outside of your traditional public stocks and bonds. You know, things like private equity, venture capital, hedge funds, the kind of stuff that isn't typically on the menu for the average investor. Now, you might be thinking, okay, putting a quarter of your money into exotic stuff like private equity, that sounds incredibly risky, right? Well, this is where this story gets really, really interesting. First off, the data shows that, yep, the wealthiest investors do get higher returns. Now, it's not some massive blowout difference every single year, but over time, that extra 0.5% or so, it really compounds into an absolute fortune. But that return, that's really only half the equation. It's the other half, the risk side, that truly reveals their secret edge. And here's the big puzzle. The wealthiest investors, the ones with all those alternatives, they're getting higher returns while taking on less overall risk. I mean, look at the volatility numbers. They are completely breaking the #1 rule we're all taught in finance, that if you want higher returns, you have to take on higher risk. So that brings us to the obvious question, right? How on earth is that possible? Where is their edge coming from? And the answer, as you've probably guessed by now, lies back inside that big, mysterious slice of their portfolio, their alternative investments. Okay, this is where it gets really important. When the researchers broke down the returns asset by asset, they found something fascinating. In public stocks and bonds, both groups performed pretty much the same. The entire performance gap, all of it, came from alternatives. The ultra-wealthy were earning over 7.5%, which is more than double the other group. So let's be clear. The secret here isn't that they're some kind of stock market geniuses. Nope. The real edge is hidden deep inside what they're doing with their alternative investments. Okay, so what are they doing so differently inside those alternative funds? Well, let's get to the final reveal. Just look at this. It's a staggering difference. The less wealthy group, on average, holds about 3 of these alternative investments. The ultra-wealthy, they hold an average of 36. That's more than a 10-fold difference in the sheer number of positions they hold. So the immediate thought is, okay, they must just be way better at picking the winners, right? They have access to the secret, can't-miss funds that nobody else knows about. Well, the data from the study gives a really clear and frankly kind of surprising answer to that question. Nope, they're not any better at picking individual winners. In fact, the study is super explicit on this point. When you look at the individual funds they invest in on a risk-adjusted basis, they're no better than anyone else's. So let me say that again. They are not better fund pickers. So, here is the real secret. It turns out they're actually buying riskier individual funds. But, and this is the whole key, because they can afford to buy so many of them, they build this incredibly diversified portfolio. Think of it like a movie studio. Instead of betting the entire farm on one giant blockbuster, they finance dozens of smaller, riskier indie films. They know most will probably fail, but the massive success of just a few hits will more than cover all the losses, and then some. So, after all that, what's the big takeaway here? What does this all really mean?
The true edge of wealth, it turns out, isn't some secret knowledge or a magic formula. It's really a two-step process. Step one is just having access to these private markets in the first place. But step two is the crucial part, having enough capital to buy a ton of these things so you can diversify away the massive risk of any single one of them failing.
And all of this leaves us with a pretty provocative final thought. You know, we hear a lot of talk these days about democratizing finance and giving everyone access to private equity. But if the real secret isn't just getting into one or two funds, but having the ability to own dozens of them, can opening the door a tiny crack for ordinary investors ever truly close the gap? It's definitely something to think about.